Friends, welcome to the channel JIV and CIV Made Simple. From today onward, we are starting BFM crash course. This is the day number 1 and we are starting in the reverse order. First of all, we will see unit 31. The topic name is RAROC and profit planning. What should be our methodology? I will provide you videos which is very short, which only consist of such kind of mind map, as you can see, right? This kind of mind map and flowchart. Right, after watching this video, which hardly takes 30 minutes, you go to solving MCQs and quizzes which I have added in the today's folder. You check your understanding whether you are able to get at least 60% marks or not. If not, then you again revise the syllabus. So the MCQs portion or the quizzes consist of both numerical as well as theoretical question, and you will try to cover everything. You will try to cover every kind of formulas that is asked in the examination. So let's get started with our first mind map, that is our strategic profit planning and investment in the banking institution. Ever wondered how banks balance profit and risk? How do they maximize earning while ensuring financial stability? Let's bring simple and powerful way. Right, so there are two things. On one side, on one side we have risk, right, and on other side we have what? Return, or we'll call it profit, right? And also, how do they maximize earning? So first of all, let's look at this particular diagram. On one side, let's look at the objective of the bank. So basically, at the heart of the banking lie a key mission. The mission is to profit generation. Yes, profit generation is the key mission of banking, right? But banks serve as an intermediary, right? Banks serve as intermediary, turning deposit into loan, and this loan fail, they turn deposit, whatever deposit they receive from customer, they turn deposit into loan, and those deposits fill the engine of industries, trade and agriculture. That is the point, turning deposit into loan, and that turns engine of industry, trade and agriculture. Now friends, let's look at the other part of it. The other part you can see is the investment strategy. What is the meaning of this investment strategy? Left part you can see that bank carefully design their investment strategy by balancing risk and reward. Yes, I already told you that risk and reward has to be balanced, and that is how they carefully design their investment strategy, right? So there are some low risk investment like SLR, right? Like those regulated under SLR, those investment which are regulated under SLR, they are safe, they are low risk, right? They offer stability but lower yield. Obviously, since stability is there, so yield is also lower. On the other hand, corporate debt and some high risk instrument there, they promise some great reward. The secret is that optimizing balance. This is the secret. The secret is to optimize the balance, right? To optimize the balance to maximize profit. Optimizing balance to maximizing profit while staying within the risk appetite. This is the secret that the bank follow. That yes, they optimize the balance, right? To obviously they want to maximize profit their profit, but staying within the risk appetite. That is the point. Now let's look at the next segment of it, that we have something called profit planning framework, and on the left side you can see it here, profit planning framework. Friends, let's see. A bank earning are not just from loans, right? They have multiple income streams, like through interest income. They have some interest income, right? Like interest incomes like through loan and bonds. There are some fee-based services they provide, like account maintenance and transactions, and treasury-based service, treasury operation. That means they're trading in forex, right, and securities. So these are the multiple incomes of bank, right? And if you look at the dual responsibility of bank on the right side, you can see. So friends, you can see that bank wear two hats. They act like a trustee. They act like a bank, act like a trustee, right? Ensuring fund safety with fixed return, right? And ensuring that your fund are safe. Whatever you deposit in the bank, it remains safe with fixed return. But here is the catch. They must also maximize profit, right? They must also maximize profit, right? While managing the risk. This creates a natural conflict. Obviously, a conflict get created, right? Making risk management and balancing the risk the key to success. So risk management and balancing and balance the key to success. So friend, the conclusion is that strategic profit planning is bank is all about striking the perfect balance. It's all about striking the perfect balance. That is called strategic profit planning. That is what we are discussing right now. So it is all about striking the perfect balance between earning high return while maintaining financial security. If you want to dive deeper into the banking strategy, stay tuned, because in this way we provide you every content for each and every unit of BFM in single chart, in single diagram. You will get to know every aspect which is covered in 2 pages of the book. If you go through Macmillan, 2 pages that have been covered in the single diagram, and every aspect have been discussed, nothing have been left out. So we have discussed the profit framework planning, we have discussed the investment strategy, objective of bank, and dual responsibility. Every aspect has been considered. Now friends, let's look at this diagram, and every aspect of this capital will be crystal clear to you after going through this diagram. This is the essence of our crash course, that we try to provide you every detail in a single diagram. This will be help you in the time of revision. When revising before the examination, you once see this particular diagram, everything will be recorded in your mind, and you can answer any question, whether it is theoretical, whether it is numerical, no matter what. So friends, managing risk in banking is an art, but how do bank measure risk and ensure that every investment bring the best possible return? The answer lies in risk capital and RAROC. Yes, the answer lies. What is the question? The question is, how do bank measure risk and ensure that every investment bring the best possible result? The answer lies in risk capital and RAROC. What is RAROC? RAROC means risk adjusted return on capital. So let's simplify this powerful concept. First of all, expanding the scope of risk capital. This is this part. So basically, risk is not just about credit. Bank must also consider the credit risk, which is the possibility of borrower defaulting, the operational risk, which the losses from failed internal process, and there is interaction between market and credit risk. Like suppose how market fluctuation impact lending. Now, so this is the expanding risk capital scope. Now let's look at how do bank calculate the risk capital. Let's look at it. How do they calculate the risk capital here? So basically, one of the most used method is called VAR. VAR calculation is the most useful method, that is called value at risk, to measure the risk capital, right? So what is the formula? It estimates the potential loss. The formula is RC is equal to notional amount multiplied by volatility. This sigma is called volatility, and multiplied by confidence factor. This 2.33 is called confidence factor. So corresponding to 99% confidence interval, the confidence factor is 2.33. We can also call it Z value. So this is the formula. First you write the notional amount, right? You write the notional amount, you multiply it by sigma, that is the volatility, and you multiply it by the confidence factor. This is how you calculate the risk capital, right? So for example, you can see, suppose an investor is there, right? Two investors are there. One of them traded in forex. He invested 100 million capital, and volatility is 12% in forex trading. And suppose we are trying to calculate for 99% CI, so it gives us 28 million. This is the risk capital for forex trading. And suppose another investor invested in bond, and in the case of bond, the volatility is just 4%, and suppose he has invested $200 million, right? In this case, you can see the risk capital is 18.64 million, right? So but simply knowing risk capital is not enough. Yes, we know how to calculate risk capital, just now I have told you, but simply knowing risk capital is not enough. So we have to look after the purpose of RAPM, right? Purpose of RAPM. Bank don't just look at raw profit, they compare performance relative to risk. So whenever I say RAPM, it means what? Risk adjusted performance measure. Means they compare performance relative to the risk. So the RAPM help in benchmarking. Benchmarking what? Benchmarking trader and business unit, right? This is where RAPM help. RAPM help in allocating. Allocating what? Compensation and reward. RAPM help in optimizing resource allocation. For example, let me give you one example. Suppose a forex trader is here. Here you can see. Suppose a forex trader is there, right? And suppose that he managed $100 million, right? Earning 12% profit. And a bond trader is there. He handled $200 million, right? He earned 4% profit. So, but which one is truly performed? Suppose he also earned 12% profit, right? Suppose he also earned 12% profit. So this 12% and 4% are the volatility of investing in trading and bond trader. Suppose forex trader invested $100 million, bond trader invested $200 million, and both of them get the same return. Let's say both of them get the 10 million return, right? But the question is, who is performing better? Right, but the question is, who is performing better? So this is where RAROC concept comes into picture. How to find the RAROC? So what we will do to calculate RAROC, here you will see. So for forex trader, what we will do, we will see the profit. What is the profit? For both, profit is just the same. How much is the profit? $10 million. But are they performing the same? No. Someone is performing better, someone is performing weaker. Who is performing better? For that we use the concept of RAPM. Both are having the same profit, which is 10 million. So we write 10 million in the numerator for the both. 10 and 10. You see, in the denominator we just write the risk capital. Just now we have calculated the risk capital. For forex trader, risk capital is 28 million, so we just write 28 million in the numerator, and after calculating the percentage, this gives us 35.7%. and for the bond trader, you can see that the risk capital is just 18.64 million. We just write here and get the percentage 53.6. So friends, in this case what we are observing, that bond trader deliver higher return per risk unit, isn't it? Bond trader, they is delivering 53.6% unit risk. They are generating this higher return. So making bond investment a safer yet more profitable option. So what is the final takeaway from this discussion is that RAROC is not just a formula, it's a game changer in the banking. It ensures that bank make risk smart decision, right? Bank make risk smart decision, balancing profitability and financial stability. So this is the quantification of the fact which we have discussed earlier, right? I just told you that yes, we have to calculate RAPM, but how do we calculate? For calculating RAPM, you know, although both are earning the same profit, whether you are investing in a trader who has invested in forex trader and a trader who has invested in bonds, both are earning the same $10 million. Yet you can see the RAPM tells you the clear picture who is providing you more return. And this is the quantification. So two formula you must remember. First one to calculate the risk capital, and second one to use the risk capital to calculate our risk adjusted performance. I hope that makes sense to you. Please hit the like button if you really think that it is adding values to your knowledge, right, this particular video. And if you want to get part of this crash course, you are just one call behind. You can WhatsApp me on this particular number. Let me write down the number here. Either save the number. For any CAIIB related query you can ask me, right? Or you can see the description section also, you will get the number. Now friends, let's switch our focus to internal capital assessment and RAROC framework. So in today's banking landscape, managing capital efficiently is no longer a choice, it is a necessity. Bank need to strike the perfect balance between risk and return to ensure stability and compliance. That is where the internal capital assessment, that is what we are going to talk about. Internal capital assessment comes into picture, right friends, and RAROC framework also comes into picture. So the core principle, what is the core principle? Let's look at it. And here you can see at the top you will see the core principle. Let me show you. This is what I'm talking about, core principle. Friends, at its heart, this framework is built on a standardized evaluation process. Yes, there is a standardized evaluation process, right? So it aims to align revenue with the associated cost of risk, right? That is called revenue cost risk match. It aims to align the revenue with the associated cost of risk, ensuring that bank optimize their capital allocation while maintaining financial stability. What is the purpose of this allocation? What is the purpose of this framework? The purpose is, you know, it links capital planning directly with the risk exposure. Capital planning, it linked directly with the risk exposure, right? It ensured compliance with the Basel regulation, right? Ultimately, making the bank more resilient. Ultimately, it promotes overall bank stability, safeguarding the institution against unforeseen financial shock. So that is the purpose of it. Now friends, after understanding the purpose, let's look at the RAROC framework. Talk about the RAROC framework. In the left side you can see, just let me show you, just wait a minute. Here you can see RAROC framework. So what does it mean? You know, the risk adjusted return on capital is the cornerstone of the model. It measures the risk by calculating the expected loss, right? It calculates the expected loss. What is the meaning of expected loss? Means those loss which can be covered by reserves, and also we have some unexpected loss, right? So what is the meaning of unexpected loss? So how do we manage the unexpected loss? By, you know, by holding capital. Either we hold the capital, or we consider some factor like value at risk, or time horizon, or diversification, or correlation. So this is how you know, we are basically measuring risk by calculating the expected loss and by calculating the unexpected loss, right? So this RAROC framework is the coordination of this model. This RAROC measure risk by calculating the expected loss and the unexpected loss. If you look at the implementation strategy, so here you can see the implementation strategy. Basically, so the bank distribute return based on the volatility of its portfolio. How they distribute the return? They distribute the return based on the volatility of the portfolio, right? Which drive capital allocation decision, right? This in turn determine the required return on capital, right? This in turn determine the required return on capital, striking the balance between the risk and reward. Now if you look at the key component of this capital assessment, right? So the assessment itself covered the three dimensions. What are the three dimensions covered by assessment? The first is called, you know, qualitative, means evaluating the bank strategy and culture. If you look at the qualitative evaluation, it look at the bank strategy, bank culture. Second is called quantitative, means analyzing risk metrics, analyzing ratios, analyzing financial figure. And finally the scope, means covering the business area, covering the product, and covering the activities to assess the overall exposure. So basically these are the three key components, right? Basically this assessment covers three key dimensions. Now let's look at the risk aggregation policy process. Lastly, bank need to aggregate all form of risk, whether market, whether credit, whether operational, into a single comprehensive risk profile. They need to aggregate all form of risk into a single comprehensive risk profile. This involves scrutiny at the head office level, HO level, and summation or risk summation of risk using RAROC metrics, right? To ensure consistency and accuracy. So friends, by effectively combining capital assessment with the RAROC framework, bank can make smarter data-driven decision, boosting profitability while maintaining compliance and stability. So basically two things are there. One thing is the RAROC framework, other is the capital allocation, and this is how this internal capital assessment works. Right. Now friends, let's switch our focus to the RAROC methodology. Let's look at this particular point. Imagine running a business where every decision carry a certain level of risk. Would not it be great to have a system that not only measures profit but also tells you whether you are taking the right amount of risk? That is where RAROC comes into picture. That is called risk adjusted return on capital. You know, RAROC is the heart of risk and capital management. It helps bank and financial institutions evaluate their performance while considering risk, ensuring smarter and more sustainable decision making. Let's break it down into three key pillars. The first pillar of RAROC, is the risk management. It helps bank and financial institution. Every investment carry risk, right? From market fluctuation to unexpected event. RAROC help analyze the portfolio exposure. Yes, which means, right, what kind of risk the portfolio is exposed to, and then it helped calculate the volatility analysis and risk factor correlation, right, to ensure that risks are properly managed before making decision. Then comes capital allocation, the second pillar. So not all investment require the same capital. You know it very well. RAROC consider the confidence level. It consider the horizon period. It consider thereby it calculate the value at risk to determine how much capital should be set aside for each investment. That is called economic capital, right? And the last but not the least is the performance measurement. I told you earlier that we first calculate the risk capital, and based on the risk capital we calculate the performance measurement. Profit is important, but is it worth the risk taken? Using RAPM, the full form is, RAPM full form is risk adjusted performance measure. So using RAPM, right, and EVA means, economic value added, right? RAROC help assess whether a business is truly creating values. So higher EVA means better performance. And let me tell you what is the formula for EVA. It is nothing but profit minus capital times K. Remember this formula? The EVA is another economic matrix that is called economic value added. It helps you decide that whether an investment is worth risk taking, right? So the bottom line is that this RAROC is like a GPS for financial decision making, guiding business toward profit while staying mindful of risk. Would you like to see a real world example of how RAROC applies? Stay tuned, because we are just talking about that. Every aspect of unit number last 31 has been taken care of in this particular lecture. Now friends, let's look at this EAR approach. Very important thing, right? Friends, what if you could predict how much your earning might drop due to risk? That is exactly what the earning at risk approach helps with. It is a powerful method used by business, used by bank to assess how fluctuation in market condition like interest rate or cash flow can impact their income. Let's break it down. Let's first of all talk about the concept of EAR. On the right side you can see. Basically, it focuses on cash flow and earning variability. What it focuses on? Cash flow and earning variability, right? So basically it helps business analyze how much their profit could be affected by interest rate change and other financial risk. That is called interest rate risk analysis. Suppose interest rate is bound to change. How will this interest rate change affect their profit? It's like financial weather forecast, keeping you prepared for any kind of a storm. Now if you look at the analytical framework here, you can see on the right, in the bottom side. So EAR relies on historical data. It relies on historical data, right, and frequency distribution, right, to estimate potential loss. It provides you the loss earning at risk, right? It considers the tail risk. That means the extreme but possible worst case scenario. That is called the tail risk, right? Using a statistical measure like a standard deviation to quantify the uncertainty. And if you look at the risk limitation strategy, is that to control risk, business set a maximum loss percentage based on past income. They set a maximum loss percentage, means how much they can withstand, how much they can tolerate. That is called maximum loss percentage based on the past income, based on the current income, based on the market value. They seek some tolerance level. This ensures that financial shock don't push them into a crisis. And if you look at the direct impact on earning, just look at the last point here. Let me show you. Just wait a minute. Let me tell you. Just look at this particular last point, right? The direct impact on earning. So basically, EAR directly measure earning risk rather than capital volatility. This make it a go-to approach for business that want to protect their income without worrying about complex capital structure. It skips the capital volatility. It directly help you calculate the current earning risk. The limitation of EAR is that every model has its flaw. EAR ignores changes in asset and liability and rely on subjective risk range, which means it may not always provide a complete picture of the financial risk. So EAR is simple yet effective tool to measure how external risk impact earning, but it should be used alongside other risk management strategy for a well-rounded financial shield. Now friends, the last topic we have, that optimizing profitability through a strategic income and expense management. So first of all, you see staff expense, which means these are the expenses that bank incur. A staff expense means salary and benefit paid to the employee. Interest income means revenue generated from loans and other interest bearing asset. Fee based, so basically it is an income part, right? Fee based income are there, right? Like income from service charge and other fee. Trading income is there, that bank buy and sell security and other asset. Interest expense is there. This is one of the major expense. So on right side you see the income, on the left side you see two major expense, which is interest expense, which means cost associated with paying interest on deposit and borrowing, and staff expense. So friends, that is all you need to read from this particular chapter, nothing else. Again I am repeating, we have just started the BFM crash course. Those who are feeling underconfident in this crash course, I assure you, with just 2 hours of practice on daily basis, you can master this subject. Yes, that is possible, because we are just focusing on only that matter from examination point of view. We have analyzed the past 5-year paper, and on basis of that I am telling you that the concept which we are covering in this crash course more than enough, right? The rest portion will be available to our paid member. If you want to get access to this, you can WhatsApp me on this particular number to get detail regarding this crash course, or you can see the description section of this video. There also the link is provided. Thank you.